Good afternoon. Welcome back. I hear the competition is pretty tough, and I also hope everyone had a good lunch and has generally had a good experience so far. Next on our schedule for the day is an engaging panel discussion on retail investor behavior evolution during and after the pandemic, implications for financial markets in India. On the topic, we have with us here today our esteemed panelists, Dr. Tirthankar Patnaik, Chief Economist at the National Stock Exchange of India, Professor Joshy Jacob, Associate Professor, Finance and Accounting Area at IIM Ahmedabad, and Professor Arvind Sahay, Professor of Marketing and International Business at IIMA. The panel discussion will be moderated by Professor Sahay, and a 5-minute question and answer round will follow the discussion. May we please request Professor Arvind Sahay to open the discussion by introducing you to our esteemed guests.
Thank you, Varuna. So, on my right, we have Dr. Tirthankar Patnaik. He is the Chief Economist at the National Stock Exchange. The NSE is also the sponsor of the NSE Center for Behavioral Science. So, I'm also welcoming him in that capacity. Dr. Tirthankar Patnaik has more than 2 decades of experience in the Indian capital markets, in academic research, finance and consumer banking. He began his career as a researcher at the Indira Gandhi Institute of Developmental Research. For those of us who are aware of this body, it's one of the finest research institutions in the country in the general area of economics, finance, developmental work and so on. And he worked on several academic and corporate projects over there in econometrics and quantitative finance. His PhD over there was in the area of high frequency finance and market microstructure, which is a favorite area of his. Then he's also worked as a consumer banking analytics as an analyst with Global Consumer Group at Citibank in India and Europe. I suspect that's part of the reason why he's happy to have a conversation with a marketing professor, even though he's at NSE. Then he has been working in equity strategy at Citibank Global Markets with Religare Capital Markets, and also before joining NSE, he was the chief strategist and head of research for the Japan-based Mizuho Bank. So we will kick off our proceedings today by requesting Dr. Tirthankar to share with us some research that NSE has done on retail investor behavior evolution during and after the pandemic. The Indian stock markets have held up remarkably well given the uncertainty over the past 3.5 years, and retail investor behavior has got a lot to do with it. And so NSE has done some very interesting work, and I requested him to share some of that as part of this panel. Professor Joshy Jacob, who is my colleague in the finance and accounting area. His areas of work are in empirical asset pricing, corporate finance, and behavioral finance. He's a very integral part of the behavioral science center over here that we have at Ahmedabad. Works very closely in the center with NSE and so on. He got his PhD from IIM Lucknow, where he got the Bharti Foundation Fellowship Award for an outstanding PhD student. He's a member of the Financial Management Association, referees for several finance and accounting journals, and is a core committee member of the JAF India Symposium, and is also on the editorial board of the Indian Journal of Accounting and Research. Apart from his typical area of research, he also studies life of plants and trees. Okay, I did not know that, so now I know that, Joshi. So over to Dr. Tirthankar, please.
Thank you, Professor Sahay, for the opportunity. It's been a very nice conference so far. I must tell you upfront, I'm not an academic, despite what Professor Sahay just told you. So the work that you're going to see will not involve any high-end econometrics that we don't really understand all that. So it will have very simple data. And I want to leave you with a small narrative. At the end of every corporate presentation, you basically want to just send a narrative, which is what I'll try and do here. So what will be new in that narrative is something that you can't generally replicate with public data. So that's where we come in. We have 94% of the market coverage in equity markets, and 99.99% in derivative markets. So we've used some of that data in the cash markets to, give you some insights on how retail investor behavior came in. It's going to be a very simple presentation, so bear with me. So this is what is a return quilt. Most of us would have seen it. It's generally, this is the choice that is given to a global investor. He can invest in any kind of assets. Why look at just equities alone? You could invest in Bitcoin. You could invest in crude. You could invest in gold. And what we have shown here is a return quilt that shows these returns over the last 10 years. And what's interesting here is the second last column. And you will notice that crude went up some 6%, Nifty was up 5.7%, and after that, after Nifty, gold was down, gold was about flat and everything else went down. Those who were Bitcoin investors lost about 64% in 2022. So 2022, in short, was a pretty bad year. One other way to look at it would be, many of us would have covered markets for a fairly long time or looked at markets. So 2022's first half was the worst since 1970. So you have two oil crises, you have the savings and loan crisis in the US, you have the 87, Black Monday, you have the dot-com boom and bust, you have LTCM before that. I can keep naming crises, and yet, and of course the global financial crisis, the taper tantrum, the pandemic, the emerging market crisis in 2006, then Fed hiking in 2018, and yet 2022 was the worst year for equity markets since the year 1970, in which S&P 500 went down about 18%. The MSCI world markets, that went down about 18% as well. DGIA was down 6.9%. MSCI emerging markets, it's not just developed markets, emerging markets went down about 20%. NASDAQ was down 32%. What did we do? We were up 6%. So what was the big deal with Indian markets that was so different in 22 is something that will be the premise of our story. And I'm going to try and answer this question in some manner. Another way to look at the same data. So I've just compared US markets with us and emerging markets and China. Just taken that part. So you have the x-axis is broken up into two parts here. So you start with 2014, where we have rebased our data to 100. And you'll notice that by the end of 2022, at the end of 2021 actually, this is the beginning of 2022, US markets and our markets were roughly similar. Chinese markets were already down. So a short way to, quick way to understand this would be that if you had put in 100 rupees or $100 in 2014 in emerging markets, you would have actually lost 10% at the end of 8 years. You would have gained about 40% in Shanghai, in the Chinese markets. In the US markets, you would have gone to 250, and in the Indian markets, you would have gone to 288. Again, big difference. And notice that this difference was not really there at the beginning of the year, 2022. So another way of explaining the same data, that the big difference started cropping in for India only in the year 2022. What was the reason? And again, just another way of breaking down. So we were up about 6%, but what was the breakup across sectors of that 6%? Who were really contributors? You notice that a big contribution came out of financials, then industrials and so forth. IT was a big laggard, which figures because US markets were down and IT sector is very well linked to the US markets, actually global markets. And another way to look at the same data. So what we are looking at now are not the index per se, but valuations. So all of us are sort of familiar with 12-month forward valuations, or rather relative valuations first, PE, and for the markets, trailing valuations don't really matter much. What people look at are forward valuations. So these forward valuations are basically coming out of consensus analysis. So we have IBES, Institutional Brokers Estimation System, and which essentially gives you the forward valuation of all stocks, about 600 odd stocks in the market. And what we've done here is shown that same forward valuation, a 12-month rolling forward valuation for the MSCI India index. That's this part of the market. And what does it show you? This is basically the premium that you're willing to pay, or the value that you're willing to pay for future earnings. So generally, you'll see that over the last 10 years, the Indian markets trade at a 15-time forward multiple. This is what the first left chart of the chart of this slide shows you. And then the one standard deviation number here is about 19 times, and below one standard deviation is about 12 times. So you'll notice that at the end of 2022, we were up a standard deviation, one standard deviation away from our long-term mean, and that long-term mean being about 15.5 times. So this is our forward valuations on their own. But if I want to look at the same data, when I compare it with our bigger peers, so for a regional investor, sitting in say Hong Kong or Singapore, India is not the only market they can invest in. They can invest in India, they can invest in any of the ASEAN markets, they can invest in China, Hong Kong, and what have you. So if you do that, if you compare India with emerging markets, turns out we have a premium there as well. Indian markets have traditionally traded at a 50% premium in terms of forward valuations to emerging market peers. What does that mean? So if you are happy to pay 100 rupees for an asset in emerging markets, for India you will essentially pay a 50% higher number. 50% higher. Why? Because higher growth, bigger economy, lots of prospects and what have you. That number at the end of 2022 was again beyond one standard deviations. In fact, if you notice, around this time it had gone to even 2 standard deviations. So Indian markets are expensive. And this happened in a year, as I said, where global markets were down 18%, 19%. So I'm just building up to the story. Same thing. Now, if you break up the markets, who essentially trades in the markets? Remember, this presentation is about how retail investors have behaved in and around the pandemic. I've not come to retail markets, retail investors just yet. So let me start with foreign institutional investors, FIIs as we call them, or foreign portfolio investors. Then I'm going to speak about domestic institutional investors. And lastly, I'm going to come to retail investors. So foreign institutional investors, what were they doing? They were selling. This is entirely expected because, as I mentioned earlier, first half of 2022 was a bad year for global markets. So your average foreign institutional investor did nothing but sell. I'm going to show this in a clearer manner here. So here you are seeing a time series. Sorry, apologies. Here you are seeing a time series. We've just done the same thing here, but with slices. So from FY16 onwards, we are just showing you how for every fiscal you begin at $0, 0 rupees, and then how do you do through the year? Notice that in the year FY23, which was last year, April onwards, FIIs have been selling. What were they doing in FY22? Selling. What were they doing in FY21? They were buyers. And before that, for about 4 to 5 years, they were buyers or sellers, but in a 10 to minus 10 band. This is the story of foreign institutional investors over the last several years. But for our story, they have been big sellers. And how much of a seller they were? The data on FIIs that we have is from 1992, and the amount of selling that happened last year has been the highest. Over the last 30 years, FIIs have never sold as much, not just in absolute value terms, but also relative terms, that they did in last year. And what did the domestic institutional investors do? Notice the same figures. They were buyers. They were sellers earlier on, but over the last 2 years, this is FY23, this is FY22. They have been big buyers. FII sellers, DII buyers. Now I'm going to talk to you about because all this is public data. FII data, DII data is available to you on NSDL website on a daily basis. This is retail data. So what we are doing here is something that you don't get in the public domain. This is basically our data, your data, my data, retail investors, not institutions. About 1 crore of us trade every day in the markets. About 7 crore of us out of 140 crores have accounts. There are 7 crore unique investors, and of them about 1 crore, it's a band. It ranges between 80 lakhs to about sometimes 1.3, 1.4 crores trade every day in the markets, and this is the money that they will put in the markets. Notice that what has been the number for FY23? Positive. What has been the number for FY22? Positive. FY21? Positive. This is FY21, this is FY22. So retail institutional investors have been putting significant amount of money into the markets. And that has been, to cut the long story short, that has been the reason why Indian markets did fairly okay in last year. I mean, they did 6% plus, but if you look at it in a relative sense, when you had global markets, whether it's the MSCI emerging market benchmark or the MSCI world or the S&P 500, there was a significant relative outperformance for India in the year 2022, and this was the reason. We just go into a little detail. I mean, if I stop here, this is hardly worth a conference, right? Let me just go into a little detail here. What we've done here is, we've looked at the retail portfolios, the FII portfolios, and the DII portfolios. So what we are showing you here is a standard concentration measure on all of these three portfolios. We have taken the Herfindahl-Hirschman index. So as you know, the higher the number, the higher the concentration. The lower the number, the lower is the concentration. And what happens here? Notice this. This is the initial part of the pandemic. So this is where maximum uncertainty was there. People sold everything. These are FIIs. Before that, you also see another term. You notice that FIIs typically have a more concentrated portfolio than DIIs. DIIs are somewhere here. Retailers buy many more stocks in their portfolio. And what you see here from a time series perspective is this portfolio concentration went up meaningfully. It went up for them, and then it also went up for retail investors. But then look at what happened. If you notice, after 2020, March 2020 was when the markets fell meaningfully. From April, they had recovered, and after that, we had a market which just kept going up all the way till, say, August. There was a respite in August of 2020. By November, the market was up around 11%. We had Pfizer coming up with their first vaccine. This is Corona, first year of Corona. We had a Biden presidency. Markets kept going up. And what did investors do? They reduced concentration in their portfolios. They were searching for alpha. They were willing to buy more and more stocks. We show the same analysis here in terms of deciles. So what we have done is we have taken turnover deciles. We've taken all the, let's say, 1,000 plus stocks that trade in the exchange on a regular basis, and then divided them into liquidity-based deciles. And what we are showing you is that when markets go concentrated, people start trading only in the top deciles. Trading in the lower deciles basically dies out. So if you see, this is a 5-year period. Trading in the top decile, for instance, in the first quarter of 2017 was just about 52%. This number shot up to 80%, 81% during 2020. This is a concentrated portfolio. People are not, what happens is when markets go down, you don't want to, what do? You sell out of your small and mid cap stocks. And then you start trading only in your large cap stocks. And then the next part, so I've basically made the point that retail investors, very simply, retail investors put in big amounts of money. That was, in one way, they were on the other side of the trade when FIIs were basically selling. But who were these retail investors? So I want to just give you a flavor of who these retail investors are. So what is it? This is a standard Gini coefficient that we have calculated. And this is a cumulative percentage of investors. This is their percentage of turnover. So exactly what percentage of these retail investors, I mentioned, right, 1 crore of us trade every day. What percentage of that retail investor class is responsible for what percentage of the overall turnover? So you will notice here that the top 25% contribute to nearly all of the turnover. And this is not now, this is 2010. What happened in 2021? The Gini, if at all, went up higher. So it's a highly, highly iniquitous market. Even though there are 1 crore of us who trade in the markets, it's a very, very iniquitous market. And next slide is about how much was their net investment. So this is an indicator of investor activity. It does, what I'm trying to say is that even though there are many, many investors, a very small percentage, precisely speaking, about 10% of them contribute to about 90% of the entire turnover in the retail base. This is one other theme. And then in terms of money, it's slightly better than what we saw in the previous slides, but not very much. Plus, between 2010 and 11 years fast forward, inequality has actually also increased. So while more investors have been coming into the markets have turned more and more iniquitous. Going forward, just a challenging macro environment. What exactly led? I'm just it bears probably more empirical, rigor and analysis by, a research crowd, which will look at what was the causality, what led to, increased retail investment in the markets. What we are trying to say here is that there was a nice macro background where you had over a 5-year period dropping positive real interest rates. People did not have enough avenues to save. They were not really getting real returns. So there was an interest in alternate assets in search of alpha in terms of higher returns. And secondly, we're just saying that in terms of a background, you had a situation where there was very, very reliable internet available. All of a sudden, you had smartphones which were available again, and then you had soft infrastructure like Aadhaar, which allows you to open a demat account very, very quickly and get into the markets. So, yeah, just the soft infrastructure, just again rapid growth in digitization also contributed to this analysis. And that led to households changing their patterns. So our analysis here is on equity markets. Let me just show you here. 2014, the household share of shares and debentures was 0.8%. It went to 2.1%. Nothing significant, but this number is more than 2.5 times. That's the incremental share, and that was big enough for. So it kind of gives you two things. It gives you how big is our household in savings pie, and then a minute change in terms of the overall number is significant enough for the markets to hold up. And yeah, these are numbers that you would have seen in newspapers. Our population, we are increasing. We are increasing demat accounts meaningfully. They are growing very, very, very fast, and yet only 7% of our population has a demat account yet. So you can understand an idea of the headroom that we have. And overall this, when people are buying a significant amount of equities, significant from equity markets perspective, not so significant from household savings perspective, as I showed in the previous pie chart, where has that led to in terms of ownership of the market? So if you see here, if you see here, this is the foreign institutional share of the market. This is a 20-year chart. This is the foreign institutional share of the market. It has hovered around the 20% figure. And these are non-promoter Indian ownerships. So DMFs, then non-promoter corporates, banks, and retail. These are the numbers here. And this again is something that you've seen. SIP numbers are kind of going up again. Yeah. And now I just want to show you couple of other points on these retail investment as well. So in terms of putting money into the markets, this is retail net investment into Indian markets since the year 2002. Again, a 20-year figure. How do we get it? Very simple. We just take every retail investor and then we realize, what was their net investment into the markets. What we do not have are stock figures. We are not a depository, so we do not have the stock figures. But after a while, these numbers don't really matter. What really matters is the incremental investment, and which is what we are trying to show here. And we are showing that incremental investment into the markets by retail investors shot up during this period. Lastly, one other important point. So notice this. What we are showing is you have promoter ownership of markets, and then you have non-promoter ownership of markets. For Indian markets, the major drivers have traditionally been foreign institutional investors. So they are non-promoter foreign institutions. So if I see non-promoter Indian institutions, that would be mutual funds, that will be insurance companies with equity participation, right? And I'm adding retail to them. You notice that this is where we are. So retail plus mutual funds plus banks plus FI, this is insurance, at 23% is now higher than the FPI share, the foreign portfolio share of 19%. What it means is non-promoter ownership of Indian markets is higher for Indians rather than foreigners. And if I actually look at free float, then the difference is even starker. Lastly, we want to show you two other things. First, when you come to the markets, do you stay there? This is another feature that we must understand of retail investors. And thirdly, and lastly, after this, I'm going to show you how exactly do we all trade. So when you see here, what we have done is we have taken a cohort of people, this is 5.8 million people, who traded in the first quarter of 2020. That's it. And the next question we are asking is, out of these guys, were they there in the next quarter? Were they there in the following quarter, and so on. This is how you see these charts. So there are two trends evolving. One is you come here, but you don't necessarily trade in the next quarter. So there is a significant amount of what will be loosely called buyer's remorse in the markets. Every time people come in, people drop. They don't necessarily follow up in the next quarter. However, having said that, the number of people trading in the markets kept on increasing. So more and more people come into the markets, they touch something, they don't really like it. A good number of them, don't follow up in the next year. But market interest keeps happening until, the first quarter of 2022. After that, this number has been coming off. So this is another feature that I wanted to share with you. While more and more people opened accounts, people opened accounts because of whatever features that we said, a macro background and then digitization and so forth. More and more people came in. Incrementally, they are not. And lastly, where is this concentrated? Largely in Maharashtra and Gujarat. But yeah, that we know already. So nothing more there. Yeah, these are the two things that I want to show you. So this is how do we trade? How do we typically trade? So we would typically trade in front of our computer, or we'll call up our broker, or if we are smart, we'll do it through our phone in the cash markets. Notice this. In the year FY18, about 5% of us were trading through mobile phones. That number today is 21%. 1 in 5 Indians, retail Indians, when they trade just through their phone. It's good enough. They don't need to, the typical. So I was in an institutional brokerage, investment banking for many years. You don't put trades unless you really think about something, you really invest. But yeah, 21% of us, 23% last year, are happy to trade through, trade through mobile phones. And this number for derivatives, which are more complicated products, as we know only too well here, it was 2% in FY18. That number is 9% today. So an increasing lot of us are happy to trade in derivatives through mobile phones. And yeah, this I already spoke about. I wanted to show you this part. When this was FY16, and this gray part is the share of foreign institutional turnover. Remember I said foreigners were the indicators for Indian markets and so forth. Their share of overall turnover was 23%. That number is down to 14%. And what is this big figure? This figure is individual investors. So the share of individual investors as a share of turnover, overall turnover is 37% in FY23. Last year it was 40%. The year before it was 45%. So, contrary to what one might imagine, institutions driving markets, institution leading markets, the major activity in Indian markets has been in retail markets, in the retail segment. Yeah, so this is a summary of what I just told you. Indian markets have done well last year despite the big drop in global markets. And a lot of macro background was the reason why we see what could be attributed to why these retail investors came into the markets. This is also seen in a big increase in investor registrations. Number of people trading in the CM and FO segment, it remains higher than pre-pandemic levels. So at least a part of, despite all the buyer's remorse that we have seen, at least a part of that additional jump in retail investors is real, and it's here to stay. Further, a lot of investors are happy to trade through mobile phones, and they are interested in. It really matters not whether it is cash markets or derivatives markets. So some thoughts about the retail markets. Thank you.
Let me invite Professor Joshy Jacob now for his thoughts on the matter.
Okay, this is a panel discussion which we have converted into a quasi presentation. Therefore, every panel need to really have a lot of divergence of views. So therefore, I'm going to build upon what Tirthankar has set out. He has very wisely or intelligently did not really portray the investor as being wise or being foolish. Rather, he said their participation has increased, institutions have exited, and these guys have taken over, right? So what I'm going to build on is I'm going to share evidence about what had been the kind of investments that retail investors did. Did it help the market at all? And how is the performance of the retail investors compared to their own record? And does that allow us to portray them as outrightly stupid and foolish, or does it portend and give a caricature that they are very wise investors who are providing liquidity and stabilizing the market? That's the idea that I'm going to do. Of course, the data that Tirthankar presented did not allow him to do this analysis. So what I'm going to do is I'm not going to really show any great data. I'm going to read on from data that had been subjected to enormous scrutiny in the US market. This is data of the Robinhood investors. We know that Robinhood investors is a new phenomena. Red Army was not present. Now we have a huge assemblage of Red Army. And these investors did not really have significant participation in the market, but they came around during the pandemic. And just to read out, their volumes increased by 3x. 3 million investors were added in the first quarter of 2020. And not just that the Robinhood investors populated the market. If you look at the conventional brokerage firms in the US, Ameritrade and Fidelity and so on, their own retail volume went up by about ranging from 40% to 50%. So now the question that comes is, if these investors, because there is a sort of lowering of the participation cost, as Tirthankar has already mentioned, you can just trade from your device. The transaction cost had been brought down to zero. There is a gamification that is provided. You refer someone else to the brokerage firm, you would actually get a gift of a stock. So the fact that there is a lot of excitement in participating, there is a gamification that is being done. Do these investors necessarily fall into the trap of very poor trade and therefore create destability in the market? In fact, those of us would remember that the critical question that behavioral finance tried to address is, early on, is that retail investors are noise traders and therefore they ought to be losing their capital to the institutional investors. If at all what they do is they increase the volatility of the market and make asset pricing riskier. Therefore, if asset prices become riskier, the cost of capital will go up. That makes asset allocation difficult. Companies would find it hard to fund their projects. Rather, they become a nuisance to the market. That was the view that we had. But what we find is something very different. Of course, I don't really have that in the slide because that's not my research. It is someone else's research that I'm quoting. Okay. What we find is, what kind of assets did they invest? Question one. What we have found is they have invested stocks which can be called as typically momentum. That is nothing unusual, right? Because we know that retail investors are largely momentum traders. Stock prices go up, they go and invest. That is nothing unusual. But what we see here as different is that they have been investing in momentum, but they also picked up significant contrarian investing. Rather, what they picked up as candidates for investments are stock that actually crashed in the market. That is quite unusual for retail investors to pick it up. So the portrayal that we have is they actually did momentum trading, but more than momentum, they actually significantly invested in assets that actually got corrected in the market. That looks like, at least the smoking gun is, it looks like they've actually identified assets which are misvalued on account of the panic that created by the pandemic. So that is one. Of course, while they have actually looked went after stocks that actually had corrected, in doing so, they actually went after a lot of sensationalism. So if you take a set of stocks that actually crashed, which they picked up, in the cross-section, what kind of assets did they invest? We have an answer. Stocks that had actually gotten a lot of media coverage. these are stocks that had been sort of particularly known to be impacted by COVID, and the media covered a lot of such details. Oh, here is hospitality industry down, hospitality industry had become hostility industry, right? No one want to go there. So obviously these are stocks that they invested in. That's one evidence that we have. So when we look at the asset allocation, they picked up contrarian is the strong theme that emerges, which looks like investors, they are acting like institutions with a lot of patience for those assets to recover. That's number one. Number two, a bigger question or a more profound question is, therefore, did their trade destabilize the market? What's been found in two separate studies is that the demand curve of institutions are generally very inelastic. If a pandemic is going to hit and that is actually going to impact your capital adequacy somewhere else, you may want to quickly sell your stock market assets and realize cash. Therefore, your demand is quite inelastic. As opposed to this, what retailers did is, where the institutions exited, they actually went in there. Therefore, they suddenly became liquidity providers. In fact, on all measures of liquidity, in stocks which had been populated more by the Robinhood investors, they find that the bid-ask spread has shrunk, the impact cost has declined. They also found that the order imbalance is much lower in such stocks. Or rather, let's imagine our experiment is, if there are 1 million investors who are registered under Robinhood, if you try to look at those stocks with the maximum number of Robinhood investors, out of the 1 million who are there, those stocks with high concentration of Robinhood investors had the least liquidity problem during the crisis. Rather, in fact, liquidity significantly improved for such stocks. In fact, what is being talked about is, or quantified is, the impact on liquidity attenuated by the Robinhood traders is about 40%. So therefore, so does it really give an impression that these investors are destabilizing the market? It doesn't. It seems like rather they are actually absorbing the liquidity. I mean, they have become liquidity providers at that point. In fact, of course, a question then would come, are they necessarily becoming aggressive in trade? We have evidence that they are becoming aggressive in the trade. In fact, I'll just read out a number. The amount of marketable limit orders placed by retail investors, particularly Robinhood investors, were around 320 billion the month before the crisis, which is February 2020. In the month of March 2020 and first week of April, that shot up to 800 plus billion, which shows that the retail investors have become more aggressive during that period. But effectively, the outcome being they actually provided liquidity to institutions, stabilized the market. That's the view that we get. The third point, therefore, quickly to conclude what I'm arguing here, therefore, the third question is, okay, you actually stepped in, you increased your presence in the market, similar to what happened in India. You actually became more aggressive, you provided liquidity, stabilized the market, but did you do it at your own cost? Therefore, there is a question of, is your performance much worse than, or rather, are the stocks populated by Robinhood investors, are those stocks worse performers compared to those which are less populated by Robinhood investors? You would be surprised to see that the answer is an emphatic no. In fact, stocks which have been invested to a greater extent by Robinhood investors, they seem to have relatively done well. And as a collective, the Robinhood investors have actually earned an alpha after adjusting for all possible factors which you would know, including profitability, investment factor, momentum, and so on. Therefore, the sense that we get, and the argument in most of the literature around the COVID crisis of retail investors' behavior is not one of a destabilizing force, but one of which is stabilizing the market by providing liquidity, and thereon alpha seem to be remarkable and something that is giving an impression that they are actually, the wisdom of the crowd seem to be helping to stabilize the market. With those opening remarks, I step back. I am usually one who takes a behavioral view and a stupid view about the retail investors, but I have argued the reverse today. So let's see what happens further from here.
Thank you, Joshy. So, first of all, let me start with a confession. I'm the non-finance guy over here. So, please bear with me. These are the experts over here. So, my comments will be a little less well informed as compared to these two. But I'm going to bring in the behavioral biases that investors are subject to in all of these areas. And I'm going to speculate a little over here. So let me start out with the time of in India. You are around March 9. Things are hotting up. The Prime Minister calls a meeting around 17th. Then you have that one-day thing around 24th. By the way, stocks have already started falling from the end of January, right? The Olympics get postponed towards the end of January. 2020 is the year of the Olympics. The Olympics get postponed around the end of January. And around that time, the stocks have begun to fall. And that fall accelerates and you reach the bottom of the market, that 40% fall that you had in BSE from 42,000 to approximately 26,000. That happens in that 1.5 month period, right? So that's a humongous fall, right? 40% fall. And I'm now a retail investor in India, or I'm a Robinhood investor in the US. I do have some stock portfolio in the market. Now, let me argue why the stupid behavior of the retail investor actually turns out to be a wise behavior in retrospect. So, two assumptions I'm going to make, and then I will invite your reactions, both your reactions. Two assumptions I'm going to make, that as a retail investor, I'm watching this fall, and I'm subject to the overconfidence bias. This is a temporary phenomenon. It will turn. I'm overconfident that the stock markets will turn, and so therefore, I think there is some potential upside. That is one. The second bias that all investors are subject to quite a lot is that of averaging. I bought at a certain price and I bought at 100, the price has gone down to 70. Instead of having exercised my stop loss, I'm still holding on to the stock. And then the thought comes in my mind that if I buy a few more stock at 70, the average price that I have bought it at is now 85 if I buy an equal number. So now if it goes up from 70 to 85, I will make a profit. So that combination then brings in a whole bunch of initial people into the market, and the market starts to reverse because the bulk of the sales which is bringing down the stock price is now come down. Has played itself out. So the stock has bottomed out, and suddenly there is this wave of now retail money which is coming into, and that starts to take the market up. And as the market starts going up, more and more retail investors, now subject to the herd behavior, mirror neurons and herd behavior, come in, and it starts to go up. And this is speculation now. I'm hypothesizing completely without any information or data, but just based on some observation that I have. So what I would like both of you guys to now kind of respond to is this a scenario that you think is feasible, or would there be some other potential explanations for what has happened, that actually retail investors continue to behave like they normally do, but this was a situation in which the combination of overconfidence and averaging plus herd behavior actually turned out and made it into a net positive for them. And over a period of time, that net positive then accumulated because it became a self-fulfilling prophecy. So first, Tirthankar and then Joshy.
So I'll also go back to March 2020. I remember sitting in my office and seeing Kotak Bank It's a very, very, liquid stock, darling of foreign institutions. Generally, there is reasonable liquidity on that counter. And we were debating when would they shut the exchange, if at all. At that time, there were no direction, there was no clarity. Same time of March 2020. And what I remember seeing is, and yes, I remember Nifty numbers. So January was 12,000 plus, lifetime high, and then it had come down and started correcting right then. The big question at that time was uncertainty. We just didn't know what will happen. Just did not know. It was like world-ending uncertainty. Nobody had any idea. And I remember seeing there was no buyer on such a counter. And that day, the market fell, it went lower circuit. Usually, only when there's a significant drop in the markets, 10% is when the market shuts for the day. It hits a lower circuit, and it was that meaningful. So this was the period of massive uncertainty. Fast forward to, and then we had our national lockdown. By the first week of April, there was some understanding that the world will not end. A lot of people might lose their lives, but the world will not end. And people had started nibbling on stocks, because a lot of stocks were available at 25%, 50%, corrections. There is a paper by IIMA professors, Sobesh Agarwal, J.R. Verma, I don't know who, Sumit, you might know, which basically spoke about how the derivative markets got it right in April of 2020, that some of the indicators showed that the major uncertainty in the markets was gone. This is our most liquid market, the derivatives market. So my reading of the story would be, sir, that institutions abandoned the market in March, and that was essentially foreign institutional investors, because a lot of the risk comes in. And at that time, as I showed in the presentation, you need someone on the other side, and 2022 had domestic institutions and retail players who basically ensured that, and I showed by my ownership chart, that they had enough money to put in that the markets didn't really go down. So in March 2020, there was no one on the other side initially. But what we see is, one segment of the retail investors, that huge inequity that we saw in retail investors, the high net worth individuals, they started putting in money, around the first week, second week of April, and then it started playing out. By mid-May, the markets had largely corrected and come back to their levels. And then you notice by June, markets had started creeping up, but there was an enormous amount of uncertainty. Typically, what we see is markets move up when there is uncertainty. When everybody thinks the market will go up, no more movement, no more higher movement. People remained uncertain all the way till November, at which time things started moving up. So my take of this story is retail investors were not in the initial part of the game, even though we see them as retail investors, because one conscious effort we have done is government basically tells you that whoever or low high net worth versus retail is a threshold of 2 lakhs. We have not done any such correction. We have basically said, if you are an individual PAN holder, you are a retail investor. And that retail investor, so let me just give you some figures here. Out of the 1 crore people who traded on a regular basis, 40% of them didn't make money. About 60-70% of them didn't even reach 50,000 rupees. So, and then at the last decile, sir, the numbers were in dozens of crores. So you have a very, very wide distribution. And
so you should tell us who those people are.
And there is a very long tail, and this tail only started participating in the next year, in 2021, because that's when you see retail investments starting to come more. Yeah. So initially it was capital going out of foreign institutions, it was capital going out of domestic institutions as well, but finding its way into markets directly, having taken cues from the derivatives markets. And by the third quarter of the year, foreign institutions had come in. Retail investors saw the markets go up by 50% from the drop, and nothing like demonstration effect. Again, behavioral finance. So if something works, in your analysis also you said that people got interested where there was already higher action going on. So 2021 was where retail investors really got into the picture, and then they have not looked back. So
I think Arvind has put me in a spot because I had been arguing that it looks like not only that Robinhood investors are not wrong, but they seem to be, really pushing the institutional investors to a corner. So I have to now sort of sort out the contradiction that I have. Let me start from what Arvind argued. I would say that part of that story is true. There are multiple biases that are operating. Since both of them referred to some event in March, I have to also go back to an event in March. This was, I think, March 19th or so. I and one of my colleagues in the area had been invited by ICICI Brokerage to really do a webinar for their investors who had been panicking. So I went back and I actually have one of those charts here. I don't know whether you can see that right now or not. I think it can't be seen, but let me just open it up. Yeah. So we just put out this is exactly the same quote that I had put out there at that point in time, that there are decades where weeks happen and then there are weeks where decades happen. I don't think the investors have understood the meaning of that. Because most of them were actually quite impatient for far too long and lost out an opportunity to invest in the Indian market. And they saw this is like a God-given moment, because first dip I should buy. Therefore, the point is that a lot of investors did not understand what does a pandemic would mean. Not many people could realize that there could be multiple waves of the infection going through. There will be lockdowns which are one after the other. Rather, they thought it is very easy to buy and it'll very quickly recover. What they could remember is that the 2008 crisis, they invested, quickly recovered. By November, December, Fed had put in so much money, markets were back to normal. Therefore, this is another godsend opportunity. So there is overconfidence, yes, overconfidence about what will be the kind of sustained, enduring impact of the pandemic. It was there in the market. In fact, you just look at these two charts. We were looking at the market reaction, as you can see. This is the market reaction to things that have happened around the lockdown in Italy. Market reaction then around March 11th, WHO declares it's a global pandemic. And then there's a gender curfew that actually happens, right? The market reaction to most industries, of course, you can see them negative because you would expect it to be so. Except pharma and electronics or telecommunication industry, you have a positive blip there because, of course, you are actually expecting these stocks to do well. But you can see that the market did not understand this correction that you have is the actual lockdown that is clamped down. On announcement of the actual lockdown, the market got corrected far more fiercely. So what is the point? The point is, despite the Imperial College report out there, very clearly arguing that this pandemic, to deal with politicians in the world, will have to really go through multiple rounds of lockdown. And so many people would perish in this. I don't think investors would understood the severity of that even when a gender curfew was announced. Or rather, the second bias that comes along with the overconfidence that this would recover like the 2008 GFC, there was actually the availability bias, right? Because you are just operating on what quickly were available to you. Though there were reams written about the past pandemic, but I don't think many of us actually had that available in our memory. So therefore, I would partly argue with that. The third is, as the market started to quickly recover, as it did, we can say that by mid-April, we were actually quite back, 40% up. The fact that you had actually so much of money made on the market, that actually led to another bias, that suddenly it is actually you earn so much more money on the market, right? So therefore the house money effect started to really build in. You can actually play with, take much more risk with that money earned on the house rather than on your own money. Therefore all of that actually led to a significant investment and overconfidence by investors. I do agree with that. Now, however, that actually challenges the statement that I made. Investors are in a way debilitated intellectually and making mistakes in doing so is somewhat straight away contradicting with what I had argued before. The difference is, what I have referred to is the is the Robin Hood investors. The difference of the typical retail investor who's acting on his own whims and emotions is that guy is actually like Elon. He is not really doing a coordinated action. He does not really have a fearsome reputation. Therefore, institutional investors think that they are like cattle fodder who could be eaten away in the market, right? They put wrong orders. I play on that. I make money and they get actually fried in the process. But did we not notice, and that is the important point to bring out here, the big difference for the Robin Hood investors is they were exactly like a Red Army. If you are very sure that here is a command control without having one, you make a statement in the Redditors and that says, let's march towards GameStop. If all of them marched in unison, then the institutional investors have to really retreat. So therefore the differences, the point that one is arguing is, why would often say that retail investors can be easily vanquished by the retail? It's not true when there is a coordination mechanism. The big difference of the Robin Hood, which I wanted to highlight here, is they had an essential coordination mechanism that made them very powerful. Therefore, in opportunities that Redditors were actually engaging, institutions had to retreat and they actually cornered that space. In fact, those who are interested in finance scholarship, you would remember that in DeLong's paper, the first paper on noise trader risk, there is a particular term that he is using. He is calling that as create your own space. If the noise traders create their own space and push out others, they may create a valuable opportunity to make return to themselves. In fact, what we saw here is the first time in financial market history, there is visible, clear evidence of Robin Hood investors creating a space for themselves. Let me just stop with this example. I hope you remember that Melvin Capital, which had actually put money in GameStop, which is a brick and mortar games company, which had little value during the pandemic or going forward, the retail investors took it to far high, right? And Melvin had to really lose the game. The point is that a powerful institutional investor could actually be pushed and could be forced to do fire sale, shows and demonstrates the power of organized, coordinated retail investor like a Robin Hood, which is why they seem to have, stuck out. However, let me just argue one more. Though we have found them to be brilliant and soothsayers from the COVID-19 investment that they did, but that is still too short term. In fact, Tirthankar and Arvind and everyone here would agree, if the markets were to go up tomorrow, it will go up today. Therefore, whenever characteristic market rise, uncharacteristic market rise like this happened in pandemic, many years probably the market may not necessarily generate further returns. It may remain flat as where it is. Given 25 PE multiple, it may remain where it is. Therefore, when we look at these investors 5 years later, you may not find them to be so remarkable in future. Right, I stop here.
Yeah, fair point, Joshy and Tirthankar, but you made an interesting point, if I combine a portion of the responses that came from both of you, which was A, that there is a limited set of people who have come into the market who are driving up the market prices in India to start with, and B, that it is the coordination of the crowd in a sense that is enabling the individual to take on the institutions. So would that mean that in a sense there was some limited coordination in India also, despite the fact that there was no Robin Hood formal mechanism available over here, would be my question. Between, let's say, the beginning of April 2020 till September, October, when then things become a lot more stable.
Can I start, Tirthankar? I think while there was no apparent command control or messaging to really get them coordinated, I thought there were other subtle coordination mechanisms, right? Number one, you keep at home people who are extremely high on their hormones. These are young women and men who are actually being forced to work from home or sit at home without any work. then obviously they will have to really spend the energy somewhere, right? Either TV game. If you would actually probably spend time in online gaming, they thought stock market is another online game to play. So that became a one coordination mechanism. The second, I think, as market quickly recovered, they could quickly see the semblance of a 2008 kind of a crisis, which is recovery made a lot of money for investors. Therefore, I think the fact that they quickly made money, a lot of evangelization happened on account of that. We know that there is a fundamental model in finance, which is actually called a model of imitation. If someone is making money by investing, then that news actually spreads very like a wildfire. The virality of the news alone will actually evangelize a lot of others. So that became the second coordination mechanism in my view. Tirthankar may have other observations.
I would just say that this continued meaningfully the next year. So 2020 was when people saw that, the markets move up 50%, as I said, mentioned earlier, which is why if you notice domestic investment, it just kept happening. In fact, what is interesting is in the chart I showed, when foreign institutions were selling, domestics and retail investors were buying. This was not the case in the fourth quarter of 2020. People got so excited that they got money out of active mutual funds and invested it directly. There was so much money to be made. People just realized that there was that evangelization, as you call it. I would use FOMO. Was so much that people took money out of domestic institutions and put it directly into the markets, which of course fed into the returns.
So let me open it out now to the audience. If you have any questions, I have a couple more, which I'm always happy to ask them, but I'd love to have some questions from you. Hanji.
This coordination.
If you can just introduce yourself also. And your
Hi, I'm
affiliation.
Smith. I'm from Good Business Lab. One question I had around the discussion you had, coordination, was something like how strongly Fed or governments would react, and that's like started the queue for everyone to kind of get back, because institutional investors might have kind of underestimated how strongly governments and Fed would kind of come into the markets, and kind of then that might have been the happenstance that helped people get more money out of it.
So that too, right? I mean, by April, people realized that unlike 2008, when the coordinated action globally was on the monetary side in terms of zero interest rates, and then which eventually went into quantitative easing. This time it was not just zero interest rates and quantitative easing. There was a significant fiscal impulse also taken up by, largely it's initially the Western governments, meaningfully so. So that would have, also formed a good bottom for the markets. And then, as I said, people realized that the world is not going to end. See, there are two things. Around April, on the pandemic, one realized that it's not going to kill everybody. And by November, when the Pfizer-Moderna vaccine first came in, that was the big jump. So these are 2 points from a pandemic perspective, and of course, policy action by the governments and the central banks. So central banks went back to zero interest rate policy, having talked so much about moving away from zero interest rate policies for the last 10 years. They went back to it immediately. They went back to quantitative easing, and plus over that you had a significant fiscal expansion by all governments. So markets had to sort of move up from that perspective.
To add to this point, I think the fiscal handout that happened to individuals, the checks ended up in the markets at that point in time. The fact that you had also lowered, I think that's a significant departure, significantly lowered the participation threshold in the market. You could just press a couple of buttons, you get everything enabled, you get your KYC done, next moment your trade done, and therefore, and that too you have zero brokerage costs. So that all galvanized the participation in the market. Of course, for the first time in history, you could really, command a disparate crowd. And part of that crowd could have been, sort of driven by emotions of their anger against what we call as the institutional capital. In fact, if you remember, we had actually the, fight against Wall Street going on in the popular.
Just one point I would want to make here. This coordinated action, what happened with Silicon Valley Bank very recently, there was a comment from Jane Fraser of Citi. She said people deal with mobile phones. People, park their deposits. They have mobile phones. I'm not sure if we are ready for it. I think she said words to that effect. Basically, how things can really pan out in terms of coordinated action in a matter of time, which most banks in the world are not prepared for.
With that kind of asset liability mismatch. Any other points? Hanji, go ahead. There's one over there. Yeah, one here, I think.
So good afternoon, I'm scholar to Divyansh. I have a couple of questions, and if could be highlighted. So I want to know, was there any change in average holding period of the Indian retail during pre and post COVID? Was any change in the age participation? Was there any divergence? And also, can you do we have data? What kind of decision making tools were the retail using, especially after the post COVID period when they were limited inside a closed environment?
Sir, my question is in addition to this.
Yeah, please.
So even I was about to question on the age demographics only, because we are talking constantly about words like FOMO, emotional rush, endorphin rushes, and there is high arousal and valence. Plus, at that point of time, there was news in regards to millennials generation coming in workforce and governing the. So they are very high, driven on emotions for that matter. So was the demographics of age a factor for the jump in the stock market retail investors? Because that was in news at that point of time as well. And the kind of emotions we see, the kind of rush we see, the kind of jumps and herd behavior we see, that's in relation to the millennials, the way of thinking.
As I said, first, number of investors has significantly increased. Second, who are these investors? While we do not have data from our side, there is a recent SEBI study on derivative markets, which also looked at basically data from the top 10 brokers. It's there in the public domain, which basically, which actually corroborates your point and your points as well, that new entrants to the markets were millennials and people in the sub 30 age group. This is first point. The your first question was, do we have any sense of the holding periods of investors? Unfortunately, we don't. We do not have initial data of investors. We are not a depository. You have to combine depository data with trading data to realize how long is your general holding period. So exchange data basically allows you to understand investor activity, not the holding period part. And then what was your third question?
It was about tools, right?
The tools. So the amount of the kind of tools that are available today or over the last 3 to 4 years to investors has been significant. You can have algorithms basically generate your trading strategies, and you can, retailers are not allowed to use algorithms. That's for sure. But there are enough solutions available which allow you to devise a strategy, put in data, and then take the final call yourself. So the tools are significant.
So just to add to the point, without naming the firms involved, for example, today every investor has the opportunity to submit his portfolio to an online site, and you can really get a sense of how illiquid your portfolio is, how poor is the stocks on momentum, how poor are the stocks compared to what others are holding, what is the total risk of your portfolio, and mind it. If you think, you get a report that you are actually holding the absolute tail of the liquidity curve, then probably, trying to really get compensation for liquidity is not always the best strategy to do. To really get optimize your portfolio, all you need is a couple of clicks. The portfolio would be actually reworked by sending in the request to the brokers to trade it, and you will also be able to buy. Or rather, the point is, the cognitive and the physical thresholds that are required to really trade and re-optimize your portfolio had been dramatically lowered. But despite that, we would not really see still a lot of investors willing to do it. So I think that is inertial effects and whatever else is which is working. So therefore, just to put a point, multiple online platforms which allow you to really get the kind of analysis that institutions used to really, get at a huge cost. That can be done by retail investors today. Yeah.
Just also, I'd like to add one other thing. I don't know how many of you guys have heard of this platform called eToro. eToro was started in Israel, right? And what do they do? They have created a community of investors, and in the community of what do they offer? So they tell investors that if the more successful of you are willing to put your investing behavior, your purchases and sales in the public domain, we will pay you according to the number of times other investors copy your trading strategy. So these are the so-called popular investors on the eToro platform. So they started out in Israel, went to the States, they're there in Europe also. And essentially these so-called star traders, right? They do their own research, and a lot of retail investors then copy the effort of the star trader. Why is the star trader interested in sharing his research and his activity for free? Because at some level, if I am a star trader and I'm making a lot of money, the reason I'm making a lot of money is my purchases are also able to influence the market, right? And if there are a whole bunch of other retail investors, a whole crowd that is copying me, the impact of my purchases or sales, I can magnify, I can estimate upfront as to what will be the impact on the market. So there are many ways of kind of skinning the cat, if you will, in terms of behavior. Okay, I think we have time for one last question, otherwise we are over time and we can make a closing statement and we'll close. One last question if you guys have. Okay, in that case, it is my very pleasant duty and pleasure and privilege to say thank you to both to Tirthankar and to Joshy. Thank you for taking the time for sharing with us your insights on this particular issue. I think there is a paper there somewhere. Maybe Joshy and I can work on that sometime if we can get around to it. Because I'm fascinated. I actually have the opposite view from what you have said, that actually retail investors, and given the eToro example also, I think we've reached a stage where they could make a significant coordination, whether formally and informally. So there is a question there somewhere as to how much of an impact it can have on the markets, and what is the nature of the different biases that move the markets one way or the other. And maybe we can get Tirthankar to help us with it. Thank you so much again, gentlemen.
May I please request Professor Jacob and Professor Sahay to please felicitate Dr. Tirthankar Patnaik. Okay, we hope the panel discussion has left you with some interesting insights. Next up, the popular highlight of the conference for participants specifically, the EEG analysis on brain vision analyzer software workshop. A selected few made it to the workshop, and on account of a limited number of seats, we feel rather unfortunate to have to restrict registration numbers. Registered participants of the workshop are requested to move to the CR on the second floor. Please note that the change in venue is not highlighted in the schedule. Attendees and non-registered participants can proceed towards picking up a conversation that they might have left off with the poster presenters earlier this afternoon. And all conference guests, faculty, participants, attendees, and staff, every single one of you are invited to the networking dinner that is to be held on the CR2 lawns at 8 p.m. So, at the IMDC CR2 lawns. So please do be there. Please don't pack your bags and go home. Please attend the networking dinner. It's a unique opportunity to network with everyone present here at the conference. Thank you, and see you tomorrow at 8:30 in the morning for the next panel discussion. Just a reminder again, the Vikalpa team will be around tomorrow as well during the tea break, so feel free to contact them. Thank you. Enjoy your evening.